Hello and welcome to our webcast. I'm Samantha Davison with LPL Financial. I'm joined by Ryan Dietrich, Senior Market Strategist, and Jeff Bookbinder, Equity Strategist. We, as a leader in the retail financial advice market, LPL works with independent financial advisors, financial professionals, and institutions to provide them technology, research, clearing, and compliance services so they can provide objective guidance to many Americans, millions of Americans, who want information about wealth management, retirement planning, financial planning, and asset management solutions. Now, it has been roughly 5 months since the official start of the COVID-19 outbreak here in the United States. Today, we're going to talk about where we are on the road to recovery, what that means to the market, to the economy, and to your planning throughout your lives. Now, we will discuss three things. They are, first thing is the short-term impacts of the government stimulus, what that bridge really means for the new normal. Then we're going to talk about the long-term impacts of the rising national debt due to increased federal spending, healthcare support, and of course the stimulus packages. And the third thing we're going to talk about is the impact of the pandemic on the economy, on the jobs, and on consumer confidence as states begin to open up. So let's begin with thing one, and we're talking about the short-term impacts of everything that we've experienced. Let's talk about, and Jeff, we're going to start with you. Let's talk about the government stimulus. Now, right when all this started at the beginning of the year, Congress acted quickly and created and passed stimulus packages. Can you remind us what the purpose of those packages is and was at that point?
Sure, Sam. Yeah, the goal of these packages is bridge, as you say, to the other side of this crisis. We want to make sure that businesses are in a good position after the crisis has passed to drive the economic recovery. So a simple example of that is the Paycheck Protection Program to allow businesses to keep as many people on their payrolls as possible for the next several months. This has already started, but certainly continues a little bit longer. So they're in a position to spend to not only limit the magnitude of the downturn, but also drive a stronger recovery on the other side.
And you know, those packages, I mean, they came one right after the other. We've even talked to, are we calling it 3.5 packages, 4 packages? I mean, there have been a lot because the Paycheck Protection Program ran out of money and they needed more money to fund it. What would you say, how would you suggest or say that we're doing as a country with all those packages? Are we recovering?
Oh, absolutely, no doubt. Frankly, we've been surprised at the pace of the recovery. It's been great to watch, and we can give some data points to back that up here in a little bit. I think the most important point to make here is that this was a massive set of programs. If you compare it to the size of the economy, it's about 13%. So we've basically taken the entire size of the manufacturing sector and added it on top of the economy as support. I mean, the hit to the economy won't be that big. So the support that we've gotten from policymakers actually much bigger than the hole we're trying to fill.
And Ryan, would you like to add anything to that? I mean, many people are wondering what this recovery is going to look like long term, you know, whether it's going to be a V shape or a W shape. Do you have some insight into that?
Yeah, Sam, we do. I mean, here's the reality, right? Why did we go into a recession? The most vicious recession we've seen since the Great Depression. It's because the government told everyone to stay inside. I mean, that's the truth. Yes, COVID-19, the impact of that, but we're not against what the government did. They had to get things under control to help our hospitals. You know, every single week it feels like we're getting some more positive news on this fight against COVID-19, whether it be existing drugs or vaccines that could be coming. But you know, like Jeff just said, 13% of GDP. You think about that, that's a couple of months, right? We haven't even talked about what the Fed is doing. I know we're talking about the government. The Fed has done a lot of things to help also. When you look what the Fed and the government have done, they've in essence bought our economy, if you want to use that phrase, a couple of months for totally shutting down. Now, as we're slowly starting to open things back up here around the United States, we are seeing some really solid economic data that again suggests, are we still in a recession? You know, maybe, but we do think the fastest recession in history, Sam, was in the early 80s, only 6 months long. When all is said and done, this recession that we're in is going to be extremely violent to the downside with the losses we saw, but it could be really short again as we open up. And last point here, as you come into recessions, what happens, right? You think about it. There's excesses, overspending, over leverage, overconfidence. You have all these overs that tend to kill economic cycles of growth. We didn't really have those. Coming into this recession, consumers were in pretty good shape. Small businesses were in pretty good shape. And yes, that's all part of it, why we think when we get to the other side, more of an expansionary role the second half of this year, kind of bouncing back, makes a lot of sense to us here and now.
I think when we hear the word recession, though, we do tend to panic, don't you think?
Hey, absolutely. And again, we haven't had one in a while, right? We just had 10 and a half years without a recession. You go back in stock market, well, not stock market, you go back in market history. I mean, you tend to have recessions about every 5 years, okay, on average. We just went 10 years without one. What's really unique, though, about, again, this expansion, this recession, which just happened, our economy, Jeff mentioned GDP, that's our economy, it grew 50% the past 10 years. What in the world does that mean to someone listening? Well, the average expansion's 5 years. Those have grown about 50%. What I'm getting at, this is a very long cycle of growth, but it's not really the greatest cycle of growth. Again, it's a slow and steady type of grind, what we saw for 10 years, and then we came to a screeching halt. But there is no question when we hear the word recession, and rightfully so, what happened in the last 2 recessions? Our stocks got cut in half, right? Financial crisis, the tech bubble. So, and we just had a 34% correction in stocks, more on different sectors. That's on the S&P. So it's very scary what's happened. We're not minimizing at all. But again, when things are the darkest, that's when you have light at the end of the tunnel. And we do see some light here the second half of this year.
Well, so let's talk about those long-term effects. Okay, so right now we have a rising national debt. What does that mean? First of all, what is the national debt right now? And then what I had read is that it used to be that the US economy would outpace the national debt, but I don't think that's happening right now. Can you elaborate a little bit on that?
Yeah, you can take
Sure.
this one, Jeff. I'll chime in.
So it's a massive number, and it is bigger than GDP right now. It's about 25 trillion. The stimulus we've done, so we're now at 3 packages of meaningful size, and we'll probably get another one next month. So we're going to talk about 17%, 18% of the economy, maybe something in the neighborhood of $4 trillion in stimulus from the federal government when all is said and done. So the numbers are adding up, and it's going to be a little bit tricky to wind this down, because if your debt gets bigger than the economy and potentially more expensive to service, right? Just like you have mortgage on your house or credit card debt, there's a cost to service that debt. As that cost rises over time, potentially with rising interest rates, and if the pile is bigger, it's going to be more expensive to service. So we'll have to tighten our belts as a country down the road. But the good news right now for investors is that the cost to service that debt is really cheap, right? We've got a 10-year treasury yield below 1% right now, something we've never seen. So, that's really just buying us some time.
And Ryan, what would you add to that?
Yeah, I mean, I'll chime in. So the Federal Reserve does data once a year, and they look at kind of how much all of the debt costs us, okay? Again, like Jeff said, we've got $25 trillion in debt. Came into this year, call it 22, 23 trillion, added obviously a lot more with the crisis that just happened and we're still into. But if you look at kind of how much debt we have to pay because interest rates are so low, it's actually not as high as it was the last couple of decades. So on a nominal basis, yes, debt is extremely high. $25 trillion, no way to slice or dice that any other way. But when you factor in low inflation and low rates, it kind of tells a little bit of a different story. But guys, so we're doing this, toward the second half of June. I was reading some market history. Andrew Jackson, 185 years ago, actually balanced the debt in the United States. Okay, back in 1835. Now, that was one of the few times we've had a balanced debt. Since after the Civil War, the United States has had a lot of debt. Here's the truth of the matter. There have been concerns about debt since the Civil War. It's something that our country's had. Why? Why do we have so much debt relative to other countries? I mean, you could talk to 10 economists, you could get 10 answers. Here's what we know. I'm going to keep this real high level. our US dollar, our currency, is one of the strongest currencies in the world. Now, it's not all that great, okay? We call it kind of the cleanest shirt and dirty laundry. And during the financial crisis that we just had back in March when everything sold off, the US dollar was strong. As long as we have the world's reserve currency, whether you like it or you don't, the United States is going to continue to use debt to kind of help us get out of the issues that we're in. And that's a whole vicious cycle. Because I would argue the 10-year economic cycle of growth that Jeff and I just talked about, maybe it wasn't as spectacular because we had so much debt holding us back. So this is a messy situation. There's no true easy answer, but the near term, we need to use debt to get out of this. Longer term, that potentially could impact the overall growth that we do see. So double-edged sword, it's tough.
But not necessarily. So just by looking at the number, we shouldn't panic because we've always had debt, but it's how we react to it. Is that how you would describe it?
I think so, absolutely. And just look at something as simple as how much we're worth, right? I mean, people are worth a lot more money in the United States than they were 20 years ago, right? You have more credit card debt because people are worth more. So again, just because you have more debt just blindly doesn't mean, oh my goodness, we're going to be in a recession, a Great Depression, we can never get out of this. Again, net wealth just a couple quarters ago was making new all-time highs in the United States. I know when stocks pulled back, those numbers dropped. But again, it's so important to kind of, I call it denominator blindness, right? Kind of ignoring the denominator of the function of fractions there. So you have to pay attention. If you're worth more money, you're going to have more debt. That's just kind of something that's important for investors to wrap their arms around.
Well, and I think it's probably like with everything, you can't just rely on one piece of material or one fact. You have to look at all of them and put them all together and tell an entire story. At least that's how I take it. So let's talk about.
If it were easy, everybody would do it. That's exactly right. You got to take a lot of data and put it together and come out with the best idea that you can.
Okay, so let's talk about the third thing, and the third thing is really, how we're impacted by that pandemic. So how it affected consumer confidence. If you look at everything that has been done since the official start in the United States of COVID-19 and that outbreak, and everything that happened with it, with the market volatility, how would you grade how we've done as an American society, as the government, as people? How have we done in getting our economy going again and businesses opened again? What kind of grade would you give us?
Yeah, Jeff, you want to start and I can kind of take it from there?
Oh, sure. I think thus far you've got to go, at least B plus. The only reason I wouldn't give it an A is because probably moved a little bit too fast, and we've seen a pickup in cases, right, in several southern and western states. Now we're having to maybe pull back a little bit, some targeted restrictions in certain cities. But if you look at some of these indicators that suggest we've come back strong, we're looking at seated diners. People are eating in restaurants again. We were down to practically nothing, and now we're up, something like 70-80% off the bottom. If you look at a count of number of businesses open, we were down something like 75%. Now we're down like 25%. So just come storming back, and frankly, it's been even stronger than we and pretty much any economist out there would have expected was possible. So I think you got a lot of pent-up demand here. People were tired of staying at home. You give people a lot of money and tell them they can't spend for a while, then you let them loose. And what we've seen here has been a real strong return toward normal here.
And I guess
I'll just chime in real fast.
Yeah.
Jeff and I are whittling away to nothing, right? With no restaurants open, we had to cook our own food, and it was a tough situation, but things are slowly opening up. So maybe if you see us out in the future, we'll plump up a little bit as we can start eating a little bit.
So like when you look at the markets, and so obviously there was a huge dip, and then we had a huge high, and then we've kind of back and forth. I mean, what would you say, how are the markets doing, compared to the historic numbers and what we expect to see going more toward the election, and which of course historically has impacted things as well?
Yeah, I'll start that, and Jeff, maybe I'll hand it off to you as we get close to the election, what you think will happen. But right here and now, we had the fastest bear market in history. We had the fastest 30% correction in history when you look at the Dow Jones Industrial Average, which has been around 124 years. Now, the flip side to that, we've had one of the greatest rallies ever. We just had the best 50-day rally for stocks since World War II. If you look at the S&P 500. So I think, yes, LPL research, we've been a little bullish. We turned more bullish on equities in late March. Even by our wildest dreams, we probably didn't expect things to bounce back like that. But what did Voltaire tell us? He said, history doesn't repeat, but man does. And I think the stock market is kind of like man. And what I mean by that, fear and greed, emotion, that is so much in the stock market. And you think back to 2003, major stock market low, huge rally for a couple of months. Then the summer months, consolidation, little pullback, and then acceleration the second half of the year. Go to March, notice this month of March 2009, major market low, huge rally for a couple of months. Summer months again, volatility, consolidation, pullback, eventually expands higher the second half of the year. Here we are once again, major market low in March, best 50-day rally ever. We think stocks very well this summer could consolidate, maybe pull back a little bit more with the election, eventually accelerate higher. Now, Jeff, maybe over to you. What do you think as we get closer to the election? What should we kind of be looking for? What could stocks be doing here?
And then before you start that, Jeff,
Okay.
when you're thinking about the election, also tell us, they're talking about another wave of COVID. And, if you read the news headlines, we're already seeing the increase, and you even hinted at it, Jeff. But what kind of impact will that also have on the market? And maybe it's a little bit of both.
Yeah, that's probably what people are watching most closely right now who follow the markets. Are we going to have to pull back here on the reopening because of this acceleration in cases? People are saying they're afraid of a second wave, but we would argue this is probably the first wave. Some of these states that weren't hit early are getting hit now.
Right.
And the states that were hit hard early are doing pretty well right now. I'm sitting in one right now in Massachusetts, and certainly New York, very great progress, frankly. It's not over. The battle is not over, and unfortunately, people are still getting sick every day, but a lot of progress has been made. So that, I think, has given the market confidence that we can get through this, even if we do have these little flare-ups here and there. And as we get more treatments, potentially a vaccine, certainly there'll be an end to this. And while I'm really excited about the recovery thus far, and some of the data we mentioned, perhaps I'm most excited about how well the markets looked ahead, right? I mean, it's almost as if the market doesn't care about the election. A lot of people think the election would be bad for stocks, and historically there is a little volatility before elections, particularly 3 months before, as the market really starts to focus on the outcome and potential policy changes. But this market is looking past the health crisis and past the election, and really, frankly, pricing in a pretty good economy 12 to 18 months from now. It's great to see, and certainly long-term investors have been rewarded.
Well, let's talk about that. So we've talked about the three things that we've discussed today. What would you say are some key takeaways for consumers, investors, long-term with their investment portfolio? What should they be thinking about and doing if the idea is, eye on the prize down the road?
Yeah, Sam, I mean, you think about that one, right? Stocks are volatile. As we've seen this year, stocks pull back. I like to use a little story. Remember the movie Lawrence of Arabia, right? There was a candle lit, and one guy takes his fingers and stops it and just takes out the candle by squeezing it. Another guy sees this, I'm going to try that. He tries it, he burns himself, and he's like, how in the world did you do that? The guy who stopped it said, well, you just have to know it's going to hurt. That's investing. It's going to hurt. We are going to have corrections where every 10 years there's some type of a crisis. There's going to be pullbacks. There's going to be bear markets. Eye on the prize. It's very easy to say, I'm aware, but know that investing at certain times is going to hurt. But historically speaking, those pullbacks, they are really good opportunities. Bull markets tend to last much longer than most people think. I mean, who in their right mind would assume the the NASDAQ, as of the end of June, is literally making new all-time highs as we speak, right? I mean, we would have imagined that a couple months ago. It wouldn't have made much sense, but the stock market doesn't care. It is smarter than all of us, looking at all the stimulus we talked about with the eye on the prize, knowing the economy likely 6 to 12 months from now will be much better. Very likely could be a vaccine, more positive drugs. That is what we have to remember. It's a very, very rocky road, and it's so important for longer term investors to remember the best time to buy is when things are on sale, right? What's the old saying? The stock market is the only place where when things go on sale, everyone runs out of the store screaming. And once again, we've seen that, and we think very well that's going to continue, right? It's fear and greed. I mean, the stock market is man. It thinks like people. There's a lot of emotion in, but again, when things are really scary, that's actually when you want to continue to keep your long-term plan. You work with your advisor to have a long-term plan and use it as an opportunity.
But look for those opportunities. So where there's volatility, you may be able to buy more when it's a little cheaper. Can you talk a little bit more about that as well? Just looking for those opportunities where maybe you were in one type of investment, but maybe now it's time to expand a little bit and move your investments into a different area.
Yeah, Jeff, if you want to take that one, I can chime in, but I think you'd be good for this one.
Yeah, well, I mean, this has been such a hard market to predict, right? Some of the smartest, most experienced hedge fund managers out there, mutual fund managers out there have looked frankly silly, right? And so the message there, in terms of getting a little overconfident in how well you can predict where this market's going is long-term investors have an advantage, right? They don't have to report their performance every quarter, right? They can stay invested over the long term, ride out the ups and downs, and stay close to their targets. So we think that's what they should be doing right now. I think investors should be staying very close to their targets, maybe moving around, rather than, having too much in high quality bonds where you do have some interest rate risk, maybe having a little bit more in dividend paying stocks. That's one idea. Another idea might be to look for some tax losses, because even though the NASDAQ is hitting record highs seemingly every day, the S&P 500 is only a few points away from being flat on the year, which would be the biggest comeback ever from a year-to-date loss of 30%. So the market broadly has done pretty well, has been very resilient, but you can find some areas where you have some losses. So maybe taking some tax losses to minimize your tax hit next year would make sense. Energy is one area where even though the comeback over the last few months has been very strong, most energy stocks are down 20-30% year to date still.
And so when you talk about like the long-term investments and those fixed income investors, they should maybe look for alternatives. Can you give us a little bit more detail on what those alternatives could be that maybe they're not thinking about now?
Sure. Well, I think, well, first of all, maintain exposure to fixed income near your targets, because that's going to be your ballast. That's going to mitigate the downside when you have those pullbacks and bear markets that Ryan alluded to.
Right.
So we're not saying, ditch high quality bonds. We're not saying, go to cash. Keep those there, because that's your safety. That will keep you diversified. But relative to your long-term targets, it might be a good time to trim back a little bit on those high quality bonds and look to, again, dividend paying stocks, high quality stocks, good balance sheets, the things that frankly most mutual fund companies focus on, mostly in exchange traded products as well.
And I would imagine, exactly what move you make really does depend on where you are in the, retirement plan or wherever you are in your financial journey. That's, based on that, you talk to your financial advisor if you have one and decide what's the next best step for you and how you can take advantage of the opportunities that the market is providing right now.
Oh, absolutely.
Yeah.
And this is a good time to add equities if you're more conservatively positioned and you have a longer time horizon, for sure. If you're closer to retirement, want to be more conservative, then that's where you really want to hold on to those high quality bonds.
Yeah, adding to that, you look at small caps, for instance. Small caps haven't made new highs for over 2 years. So yes, we're talking about the NASDAQ strong, the S&P coming back. If you look at the average stock in the United States, I mean, it's virtually flat for the last 2 years. I mean, there's some pockets of absolute strength, healthcare and technology been really good, communication services, but your average stock really hasn't gone anywhere for a while when you factor in the recession and the big sell-off that we recently had. So it's really important, it's the old Mike Tyson quote, right? Everyone's got a plan until you're punched in the face. And the truth of the matter is that's where you want to use your advisor and work with financial professionals and get that plan in place for when the pullbacks and the scary times happen. And we're we're suggesting, like Jeff said, on the fixed income side, you can massage and change a little bit of your portfolio. On this equity side of things, you can massage and change a little bit of your portfolio. But the reality, time is your friend, and pullbacks and big buying opportunities are also your friend. So we are. Here's the truth. We're going to have another bear market at some point. I mean, there's going to be another 20% correction. It's going to happen. And when it happens, you need to use this opportunity to not panic. I mean, the worst time investors make a decision is when a time of stress is. I know we've got a couple minutes. I'll give an example of this. Pavlov in Russia, he's a famous psychologist. He rang a bell and he fed his dogs. But every time he rang the bell, the dogs would start to, slobber a little bit because they made him think of food. Interesting thing happened in 1924 in Russia. There was a horrible, horrible flood. Some of the dogs tragically died, but some of the dogs had to swim a quarter of a mile to land. After that terrible event happened, he rang the bell. The dogs that survived didn't slobber anymore. What I'm getting at is if you have an extreme time of stress, you can forget what you used to know. You make the worst decisions possible when you're under extreme stress. And that is what we've seen with investors, and psychologists have been telling us that for a long time. And Pavlov's dog showed us that. So having that plan in place before the storm comes, before the tornado and the hurricane hit, is so, so very important.
Being prepared. Key advice. All right, Ryan, Jeff, thank you so much for your time and your insight today. A replay of this call will be available within a week, and people who have registered for this call will receive that link, as well as an article talking about a lot of the topics that we talked about today. If you need help preparing for the road ahead, consider reaching out to an LPL professional. Thanks so much for watching, and have a great day.